Jose's topic for today, which is one of the income types under expanded guidelines, also known as non-QM. You always see me skip over that in the demos. It is a little bit complicated. Bank statements is a pretty standard option. That's why we keep with that for the demos, and that way we can do it every single day and do it over and over. Asset utilization is obviously one of those buttons there that you saw, one of the types, but once you open up those programs, they all act a little bit differently. So Jose has a couple specific examples here. Asset utilization, there's many ways to put it. Asset depletion, asset utilization, different ways to calculate it. Every program does it differently, has different factors. So Jose, I guess I'll let you present it and you can talk about the specific ones you use, because there's dozens, if not hundreds of variations here of ways we could do these types of programs. So it's a little bit complicated. But if you're ready, let's check out some demos. There you go.
Good morning, everybody. Thank you for joining us, Daily Rates with the Mortgage Calculator. So, asset utilization, definitely one of those mind blowers where you can actually get somebody approved by using their assets as income. Now, what exactly do we mean by using their assets? Well, we're not talking about single family homes. We're not talking about artwork. We're not talking about fancy cars. We're talking about liquid assets such as checking accounts, savings accounts, stocks, bond, or anything that can be liquidated. Now, obviously, the formula is going to be a little bit different when you're using stocks or mutual funds than when you are using checking accounts and savings accounts, which are, or money markets, which are extremely liquid. So there is going to be an adjustment to the amount of the asset. But the main thing to note is that that asset will then be used, will be plugged into the formula to come up with their monthly income. And the best thing about this asset utilization loan, because this type of product in a way, was available, for example, with your big trading houses. You had, $5 million in an account at your stockbroker, and they would let you borrow against those assets, but you have to pledge those assets, right? You actually have to give those assets as the collateral, and then they'll give you the money. In this case, you're putting the property as a collateral, and your assets are yours. You don't have to put them in any type of a segregated account where you can't touch them. And if you touch them, there's some type of a margin call. This is not the case. This is the best of both worlds. So there's a lot of borrowers out there that have plenty of money in a 401k, for example. I've run into them where they got $2-3 million. They've been working their whole life. They put away their nest egg. Another perfect example of an older borrower about to retire, or maybe semi-retired and making very little money from their actual work income, but they have $2 million in a 401k. Well, you can actually combine their moderate income plus the asset utilization income to come up with their total monthly income and be in a very good position. So it's sort of a mind blower that you can qualify them on something that they're not going to have to pledge, and very good rates, as you're going to see by now. This option is not dependent on your, any employment type or anything like that. So the only consideration is it primary or is it investment? That's really what's going to affect your loan to value and your rate. Now, obviously, it's a little bit riskier than, for example, a bank statement loan where you're seeing monthly income or monthly deposits into the account, but you're going to see very good options. And we can take it up to 90% LTV, which is the maximum on all non-QM loans when it's a primary residence. And additional bonus is that non-QM loans are never subject to mortgage insurance when the loan to value increases above 80.0%. So let me share my examples I have with you today. So first one here is our primary, and let me make this a little bit bigger for you all. Okay. This is a primary purchase, 90%, 1 unit property, and you're going to really love these rates. You're looking at 9.75 is your lowest cost option, costing 1.25 points. And you can buy that down to 8.75% at 2.375 points. Now, I will state, like I like to state in most of these presentations, that we are showing the lowest rate option based on compliance test, taking into consideration that the seller is not paying any of the borrower's closing costs. Because if you do have a contract where there is a seller credit to the borrower's closing costs, then you can apply that credit directly to the loan discount fee, and then that will not be included in the test, and then you can buy it down even lower. We do have lower options in this. So 8.75 lowest cost option, lowest rate option, excuse me. So now that was at 90%. So I always like to put this in context and show options at a little bit lower LTV. 90% is the maximum for this product that for primary, but at 80%, which is more the traditional LTV for this product, look at the rate improvement. You're looking at 8.49% at par. That dropped considerably. So, when you're looking at cost benefit analysis, you have to provide these options to the borrower if they have the money, obviously, to get there, so that they can consider. Because you're looking at, 8.49 wasn't even an option here, and it's still 2.375 at 8.75. So if 8.49 is probably going to cost you like 3 points or something like that. So you're looking at a 3% swing in cost, more or less, to get an amazing rate. So that is something that may excite the borrower. So always offer them multiple options and be the amazing consultant we all love to be. So 8.49 is par. It's our lowest cost option. 7.875 is costing 1.25, and there's probably a couple of additional options there that we can pick to go even lower and still be in compliance, probably somewhere in the low sevens. So on our primary cash out, now this is where asset utilization does differ a little bit from bank statement loans, and profit and loss loans is going to be in the max LTV. P&L, I think, is 80% as well, but bank statement definitely on the primary is 85% LTV. On a cash out, asset utilization is max 80%, and that again is going to depend on the appetite of the secondary market for this loan type, right? We don't set the guidelines. Secondary market sets the guidelines to what they want to buy. So they love the bank statement loans. Hence, bank statement loans have a higher maximum LTV on a cash out. So here at 80%, we're still some amazing rates for this cash out. 9.125 is at par, and our lowest rate option, 7.875 for a loan where you're just providing your investment account statements to qualify for income. So now we have investment options. So maximum LTV on an asset utilization investment loan is 85%. So at 85% on our investment property, 9.75% is our lowest cost option. And in this amazingly deep rate sheet, we can go all the way to 7.875% on an asset utilization purchase. How you like them apples? That's amazing. So that was at our max, right? So now, again, putting a little context into what I just showed you, this is at 80%, which is the more traditional LTV for a very non traditional product. 8.625% is our lowest cost option, almost at par, costing only 0.125 points. And you can buy that down if you choose to, all the way to 7.25%, costing 3.5 points. And our last option is our asset utilization investment property cash out refi. Again, 80% is still the maximum LTV, even though it's investment. So we got the same maximum LTV and a cash out, whether it's primary or investment property, which is very interesting to note. So 9.99% is almost at par, costing 0.125 points. And again, in an amazingly deep rate sheet, you can buy that down all the way to 8.499, costing 3.375 points for your investment property asset utilization cash out at 80% LTV.
Awesome. So, Jose, basically, you're saying even without any income, if somebody has a large amount of money in the bank, they can get this loan without pledging that money, without showing any income. They're simply using the fact that they have this cash or stocks or, whatever the liquid asset may be.
Absolutely. This is another no job needed loan. They assume if you got 3 million bucks stashed away, you're good for it. We're just you just got to plug it into the formula. Now there isn't one universal formula, right? Every conduit is gonna have their own twist to the equation. So you would just have to note that, because that's going to be another part of the consultative process that we're going to have. We're going to see what the assets amount are. We're going to look at the different formulas out there to see which is the one that works best to achieve the objective. Once we analyze the ones that work, then obviously we're going to look at the rates of the ones that work and pick the best rate for the borrower to help meet their objective. So again, it's not just about the rate in the asset utilization program. It is about how they calculate the income, right? They're going to go, and also about what percentage of the asset they let you use, what type of seasoning they may require on the assets. So there is a lot of variation in the industry regarding these calculations, something you really have to be very well aware of. So, before we get all happy, jumping and running with the lowest rate option of all the options, make sure that the asset structure fits and meets the objective so that the customer can close.
Yeah, absolutely amazing. Another one of those amazing non-QM products. I don't see any questions. We do have another episode of this on the same topic from earlier this year. And we do also have a training for loan officers on this topic. That's a more in-depth training for loan officers and how to do these type of loans. So you can check out our YouTube channel for the asset utilization loan officer training as well. Thank you for tuning in, everybody.